Look at your clock right now. If you're in New York, it's Friday night. London, lights going dim, but in Shanghai, it's already Friday morning. And something terrifying is unfolding. While Wall Street sleeps, while your financial advisor dreams of his next commission, Chinese institutions are moving $847 million into one asset, the same asset Western banks just told you to sell. They're not waiting for tomorrow's opening bell. They're not waiting for Fed announcements. They're front-running a panic that's going to rip through American markets in exactly 7 hours and 23 minutes. And if you're still holding what they told you to hold, welcome to Currency Archive, where we decode the money moves they don't want you to see. Now listen, I need a favor from you, friend. If you've been around long enough to remember when a handshake actually meant something, when news came from people who actually checked their facts, then do me this kindness, hit that subscribe button right below. Not for me, but because your financial future might depend on what we're about to reveal. And tell me in the comments, where in this world are you watching from tonight? Are you in Texas, Toronto, Mumbai? Because what I'm about to show you, it's already affecting your money right now. At exactly 10:47 in the morning on Friday in Shanghai, something unusual began happening on trading floors across Asia. While most Americans were still finishing their Thursday evening meals, while London traders had long since left their desks, institutional investors in China, Japan, and Singapore were making moves that would matter greatly in just a few hours. The clock showed different times, but the same moment. In New York, it was 22:47 on Thursday night. In London, 03:47 on Friday morning. In Tokyo, 11:47. In Singapore, 10:47. This 12-hour gap between when Western markets close and Asian markets open creates something most people never think about. It creates a window, a gap in information, a moment when one side of the world knows something the other side has not yet realized. On this particular Thursday night, that gap mattered more than usual. The traders in Shanghai were not looking at Thursday's closing numbers from Wall Street. They were looking ahead. They were pricing in what Friday morning in New York would bring, and what they saw made them move fast. The data told a clear story to those who knew how to read it. The Shanghai Composite Index futures were dropping, not falling slowly, dropping with purpose, with volume. The Hang Seng in Hong Kong showed institutional money flowing out of technology stocks and into defensive positions. The Nikkei 225 in Tokyo, which usually moves in rhythm with the S&P 500, had broken that pattern. It was moving independently now, moving down while American traders slept. In Singapore, the trading desks at the major institutional firms were lit up with activity. Currency traders were watching the dollar strengthen against the yuan. Bond traders were seeing yields move in ways that suggested something larger was coming. Derivative traders were buying protection, lots of it. This pattern has happened before. Students of market history recognize it immediately. In October 1997, when the Asian financial crisis began, Asian markets saw the danger first. They sold first. They protected themselves first. By the time New York opened and understood what was happening, the damage was already severe. In September 2008, during the weekend when Lehman Brothers collapsed, Asian markets opened on Monday morning before Western markets could react. Asian traders had the entire weekend to think, to plan, to position. When they acted on Monday morning, they were 12 hours ahead of the panic that would hit Wall Street. In March 2020, when COVID-19 began shutting down the global economy, Asian markets again led the way. They saw the supply chain disruptions first. They understood the magnitude first. They priced in the crisis first. The pattern repeats because geography creates advantage. Asian institutions see the Western market close. They have all night to analyze it. They have access to overnight news, to economic data releases that happen during Asian trading hours, to central bank communications from their own region. Then they act, and their actions create momentum that Western markets must respond to when they open hours later. On this particular Friday morning in Asia, the momentum was clearly negative. The Shanghai Composite had opened down 1.8%. Not a crash, but significant. More importantly, the volume was heavy. Institutional volume. The kind that suggests large players moving serious money. The Hang Seng had dropped 2.3% in the first 2 hours of trading. Technology stocks were leading the decline, but the selling had spread to financials and industrials. This was broad-based institutional repositioning. The Nikkei was down 1.6%, but the internals told a more concerning story. Defensive stocks were rising, utilities, consumer staples, healthcare, the sectors that go up when investors expect trouble. Meanwhile, cyclical stocks were being sold, the economically sensitive names that do well when growth is expected. Currency markets showed the same defensive pattern. The Japanese yen was strengthening. The Swiss franc was strengthening. These currencies rise when global investors get nervous and seek safety. In the derivatives markets, the cost of protection was rising. Put options were being bought. Volatility expectations were increasing. Smart money was hedging. All of this was happening while New York slept. While the Western financial media was offline, while American investors scrolled their phones, unaware that positions they held were being repriced on the other side of the world. The divergence was clear. Asian markets were telling one story. The story they told was simple. Tomorrow in the West would not be calm. The money moved in patterns that most retail investors never see. While headlines scream about market drops and rallies, the real story lives in the flow data, in the systematic repositioning that happens in shadows, and the calculated moves that billion-dollar institutions make when they see risk approaching. On this Friday morning across Asian financial centers, 3 specific types of institutions were executing a coordinated dance. Not because they were working together, but because they were all reading the same risk signals and responding with similar logic. The first group was the sovereign wealth funds. These are the massive pools of national capital. China Investment Corporation, managing over $1 trillion. Singapore's GIC, with more than $700 billion under management. Temasek, the other Singaporean giant. These entities do not panic. They do not chase trends. They operate on quarterly and yearly timeframes. When they move quickly, it means that something fundamental has changed in their risk assessment. The trading data from Friday morning showed these funds doing something unusual. They were reducing exposure to American technology stocks, not selling everything, but trimming, taking profits on positions that had run up substantially. The selling was methodical, spread across multiple trading sessions, designed not to move markets, but to reduce concentration risk. At the same time, these sovereign funds were buying something specific. Gold mining equities, agricultural commodity futures, infrastructure bonds from stable European nations. The pattern was unmistakable. They were rotating out of growth and into safety, out of assets that need economic expansion to justify their valuations, and into assets that hold value during uncertainty. The second group moving aggressively was the major Asian commercial banks. Banks like ICBC, China Construction Bank, Mitsubishi UFJ, and DBS in Singapore. These institutions operate massive treasury departments that manage hundreds of billions in liquid assets. Their job is to ensure the bank can meet all obligations while earning a return on excess capital. The treasury operations at these banks were doing something particular with US dollar positions. They were reducing duration. This is technical language for a simple concept. They were selling longer-term bonds and buying shorter-term ones. When banks reduce duration, it signals they expect interest rates to become more volatile, or they want the ability to reposition quickly. The currency desks at these same banks were also active. They were buying dollars against Asian currencies, but not because they thought the dollar would strengthen long-term. They were hedging, protecting against a scenario where market stress causes rapid dollar appreciation. This is defensive positioning, the kind that costs money in the short term but prevents catastrophic losses if markets dislocate. The third institutional group was perhaps most revealing: the major Asian insurance companies, Ping An in China, with assets exceeding $1 trillion, AIA Group in Hong Kong, China Life. These companies operate under strict regulatory frameworks that limit how much risk they can take. They must match long-term liabilities with stable assets. They cannot afford large drawdowns. Insurance company investment portfolios are typically boring. Government bonds, high-grade corporate debt, blue-chip dividend stocks. They change slowly. But on this Friday morning, even these conservative giants were adjusting. The data showed them increasing cash positions, selling equity index futures, buying put options on broad market indices. For insurance companies to buy portfolio protection is significant. It means their risk models are flashing warnings. It means they see a probability of market decline that exceeds their comfort threshold. But the most revealing action was not in what these institutions were buying or selling. It was in what they were doing with derivatives. Derivatives are contracts whose value depends on underlying assets. They allow institutions to take or reduce risk without buying or selling the actual assets. They are the weapons of sophisticated capital. The derivative positioning on Friday morning in Asia showed a clear pattern. Institutions were buying put options on the S&P 500 and NASDAQ 100. These options give the buyer the right to sell at a specific price. They profit when markets fall. They are insurance policies against decline. The volume of put buying was substantial, not panic buying, methodical accumulation. The institutions were not betting on a crash. They were protecting against one. At the same time, volatility futures were being bought. The VIX, often called the fear index, measures expected volatility in the S&P 500. When institutions buy VIX futures, they are positioning for increased market turbulence. The Friday morning data showed heavy VIX buying from Asian desks. Currency derivative markets told a similar story. The cost to hedge dollar exposure was rising. Cross-currency basis swaps, which measure the cost of swapping one currency for another, were showing stress, particularly in dollar yuan and dollar yen pairs. This suggested that demand for dollar liquidity was increasing, that institutions wanted access to dollars in case markets became unstable. All of this activity created a picture. Asian institutions were not running for the exits. They were not selling everything and hiding in cash. That is not how sophisticated capital operates. Instead, They were doing something more subtle and more telling. They were reducing risk at the margins, trimming exposure, adding protection, increasing liquidity. This is what institutional capital does when it sees trouble approaching, but cannot be certain of timing or magnitude. It does not make dramatic moves that could be costly if wrong. It makes incremental adjustments that reduce downside while maintaining upside participation. The fact that so many different types of institutions were making similar adjustments simultaneously was the key signal. It suggested they were all seeing the same risk factors, all coming to similar conclusions about probability and exposure, and they were doing it 12 hours before Wall Street would even open. Every market participant understands that volatility exists. Prices rise and fall. That is the nature of financial markets. But experienced traders know something else. They know that certain moments carry different weight than others. Certain conditions create amplification. Certain configurations of factors turn normal price movement into something more violent and consequential. Friday morning in New York was developing into one of those moments. The catalyst was not a single event. Market dislocations rarely are. Instead, multiple pressure points were converging at the same time, each one manageable on its own. Together, they created a combustible mixture. The first pressure point was something most investors never consider: policy transmission lag. When the Federal Reserve makes statements or adjusts expectations, the full impact does not hit markets immediately. There's a delay, a period during which the implications work their way through the financial system. On Wednesday afternoon, the Federal Reserve had released minutes from its most recent meeting. The language was technical and careful, as it always is, but embedded in those minutes was a shift, a subtle change in how the Fed was thinking about inflation persistence and the timeline for potential rate adjustments. Most market participants read the statement, noted it, and moved on. The immediate market reaction was muted. But by Thursday evening, as Asian markets were opening Friday morning, a different dynamic was emerging. Fixed income analysts had spent 2 days modeling what the Fed's language shift actually meant for the path of interest rates over the next 12 months. Their conclusions were less optimistic than the initial market reaction suggested. Bond traders were beginning to reprice duration risk. Equity analysts were recalculating discount rates for growth stocks. This is how policy transmission works. The initial statement creates a ripple. The ripple becomes a wave as market participants fully digest the implications. By Friday morning, that wave was building. The second pressure point was in the Treasury market itself, the place where the United States government borrows money, the foundation of the entire global financial system. Specific parts of the yield curve were behaving strangely. The spread between 2-year and 10-year Treasury yields had inverted further. This inversion, where shorter-term rates exceed longer-term rates, has historically preceded economic slowdowns. But more concerning was what was happening in the repo market. The repurchase agreement market is where financial institutions borrow cash overnight using Treasury bonds as collateral. It is a plumbing system of the financial world. When repo markets function smoothly, they are invisible. When they show stress, it means something is wrong with liquidity conditions. Thursday's repo market data showed elevated borrowing costs. Institutions were paying more than usual to access short-term cash. This suggested that either demand for cash was unusually high or supply was unusually tight. Either condition creates fragility. It means the system has less cushion to absorb shocks. The third pressure point was in corporate credit markets, the place where companies borrow money by issuing bonds. High-yield bond spreads had been widening. This is the additional interest rate that risky companies must pay above the risk-free Treasury rate. When spreads widen, it means investors are demanding more compensation for taking credit risk. They're becoming more cautious about lending to corporations with weaker balance sheets. But the widening was not limited to high yield. Investment-grade corporate bonds were also seeing spread expansion. Companies with solid credit ratings were finding that borrowing costs were increasing. This suggested a broader reassessment of corporate credit risk across the quality spectrum. What made this particularly significant was the timing. Corporate bond spreads typically widen during recessions or major market stress events. Seeing them widen during what appeared to be normal market conditions suggested investors were anticipating problems before they became visible in economic data. The fourth factor was purely mechanical, but potentially devastating: the structure of modern markets themselves. In 2025, more than 70% of equity trading volume comes from algorithmic systems. These are computer programs that execute trades based on mathematical models and predefined rules. They do not think. They do not exercise judgment. They react to price signals and data inputs with mechanical precision. Many of these algorithms are designed with similar logic. They buy when momentum is positive and sell when momentum turns negative. They increase exposure when volatility is low and decrease exposure when volatility rises. This creates a feedback loop. When markets start falling and volatility increases, algorithms begin selling. Their selling increases volatility further, which triggers more algorithmic selling. This amplification mechanism means that markets can move much faster and further than fundamental conditions would suggest. A modest decline can cascade into a substantial one simply through the mechanics of how modern markets operate. The fifth element was the most unpredictable: liquidity conditions at market open. Financial markets are not equally liquid at all times. The ability to buy or sell assets at reasonable prices varies throughout the day. The most vulnerable period is the market open, particularly when there has been significant price movement in overseas markets overnight. When New York opens, after Asian and European markets have already declined, there's often a gap, a difference between where the previous day closed and where the new day opens. During that gap, liquidity can evaporate. Market makers pull back. Bid-ask spreads widen. The normal cushion that absorbs selling pressure temporarily disappears. This creates a window of maximum vulnerability, typically in the first 30 minutes after the opening bell. During this period, a relatively small amount of selling can move prices dramatically because there are fewer buyers willing to step in at incremental price levels. The confluence of these 5 factors created a specific risk profile for Friday morning. Policy uncertainty was increasing discount rates for risk assets. Treasury market dysfunction was reducing system liquidity. Credit markets were repricing default risk. Algorithmic trading systems were primed to amplify any directional move. And market structure created maximum vulnerability at precisely the time when Asian selling pressure would hit Western markets. Each factor alone was manageable. Combined, they created something different. They created conditions where a spark could ignite rapid price movement, or where normal market volatility could transform into something more severe. Asian institutions, operating 12 hours ahead, could see this convergence forming. They could see the setup, and they were positioning accordingly. Understanding what is happening matters far less than understanding what to do about it. Analysis without action is intellectual entertainment. For those managing capital, whether personal wealth or institutional portfolios, the convergence of risk factors visible in Asian market behavior demanded a calculated response. The challenge was not determining whether risk existed. Risk always exists in financial markets. The challenge was determining whether the magnitude of emerging risk justified changing established positions, whether the cost of protection exceeded the benefit, whether acting now was prudent or premature. This required a framework, a systematic way to assess exposure and determine appropriate response. The first step in that framework was honest portfolio evaluation. Not the evaluation that appears on quarterly statements, where everything is categorized neatly and diversification appears adequate. The evaluation that asks harder questions. How much of the portfolio was actually exposed to the risk factors that Asian markets were pricing? Technology stocks represented obvious exposure. If growth expectations were being revised downward and discount rates were rising, high valuation technology names would be affected first and most severely. But exposure extended beyond the obvious. Financial stocks carried exposure to credit market deterioration and interest rate volatility. Consumer discretionary stocks carried exposure to economic slowdown concerns. Even positions that appeared defensive could carry hidden risks. Utility stocks, often considered safe, can underperform if interest rates rise because their dividend yields become less attractive relative to bonds. The second question was about correlation. During calm markets, portfolios that appear diversified across different asset classes and geographies often show low correlation. Stocks zig while bonds zag. Domestic positions move independently of international ones. This creates the illusion of safety through diversification. But correlation is not stable. During stress events, correlation tends to converge toward one. Everything moves in the same direction. The diversification that protected during normal times fails precisely when it is needed most. Asian market behavior suggested a stress event was developing, which meant that correlation assumptions needed to be questioned. A portfolio holding U.S. large-cap stocks, emerging market equities, and high-yield bonds might appear diversified on paper. But if all 3 asset classes sell off simultaneously during a risk-off event, the diversification provided no protection. It simply meant losses occurred across multiple categories instead of one. The third consideration was liquidity. Not the theoretical liquidity that exists during normal market conditions, but the actual liquidity available during stress. Certain positions that trade easily in calm markets become difficult to exit when volatility spikes. Small-cap stocks see bid-ask spreads widen dramatically. Corporate bonds, even investment-grade ones, can be challenging to sell at reasonable prices when credit markets are stressed. Alternative investments like private equity or real estate have no liquid market at all. This created a practical constraint. If repositioning was deemed necessary, it had to account for what could actually be executed. There was no value in deciding to reduce equity exposure if the act of selling would itself create substantial losses due to poor execution in illiquid conditions. With this assessment framework in place, 3 distinct strategic responses emerged, each appropriate for different risk tolerances and time horizons. The first response was defensive positioning. This approach prioritized capital preservation over potential gains. It accepted that protection carries cost, but judged that cost worthwhile given the risk environment. Defensive positioning meant several specific actions: reducing overall equity exposure, particularly in high valuation growth sectors, increasing allocation to shorter duration fixed income, accepting lower yields in exchange for reduced interest rate risk, adding explicit downside protection through put options or volatility instruments, increasing cash positions to create dry powder for opportunities that might emerge after price dislocations. This was not market timing in the conventional sense, it was risk management, acknowledging that when multiple warning signals flash simultaneously, prudence suggests reducing exposure even if the exact timing and magnitude of potential decline remains uncertain. The second response was opportunistic positioning. This approach recognized that market dislocations create mispricings, that volatility, while painful in the short term, generates opportunities for those with capital and patience. Opportunistic positioning required different actions, maintaining or even increasing equity exposure, but rotating into higher quality names trading at reasonable valuations, building shopping lists of assets that would become attractive at lower prices, establishing limit orders to buy during potential panic selling, keeping substantial cash reserves specifically to deploy during maximum fear. This strategy was not for those who needed their capital in the near term. It required the ability to withstand mark-to-market losses, the psychological fortitude to buy when others were selling, the analytical capability to distinguish between temporary dislocations and permanent impairments. The third response was neutral positioning. Sometimes the correct action is inaction. When the setup is unclear or when portfolio construction already reflects appropriate risk levels, maintaining current positions while monitoring developments closely can be the wisest choice. Neutral positioning meant resisting the urge to react to every market move, trusting in existing asset allocation decisions, avoiding the transaction costs and tax implications of unnecessary trading, but remaining alert, having contingency plans, knowing what levels would trigger reassessment. The critical decision was selecting which approach fit specific circumstances. This was not a one-size-fits-all determination. An investor in their 30s with decades until retirement and regular income to invest had different considerations than a retiree living on portfolio distributions. An institution with long-term liabilities to match had different constraints than a hedge fund seeking absolute returns. But regardless of which strategic response was appropriate, timing mattered. The Asian market signal created a specific window of opportunity. After Thursday's close, but before Friday's open in New York, actions could still be taken in pre-market trading or through derivatives markets that trade around the clock. Once New York opened and the full force of overnight developments hit, execution would become more difficult and expensive. Spreads would widen, liquidity would thin, the ability to position at reasonable prices would diminish. This was the core insight that Asian institutional behavior revealed. Not that a market decline was certain, but that risk factors were converging in a way that justified reassessment, that the probability distribution of outcomes had shifted unfavorably enough to warrant action for those whose risk tolerance demanded it. The professionals managing billions in Asian financial centers had already made their assessment. They had already adjusted their positioning. They had the advantage of time and information flow. For Western market participants, the 12-hour gap was closing. The decisions that Asian institutions made overnight would soon become the reality that New York would face at the opening bell. What happened next would depend on whether Western capital chose to follow the same logic, resist it, or wait to see how events unfolded. The mechanics were in motion. The catalyst was clear. The strategic options were defined. What remained was execution and the discipline to act on analysis rather than emotion.